All right, welcome. Today, we're going to tackle a topic that can feel, well, a little intimidating, but is absolutely essential for your financial future: mutual funds. We're going to break it all down, piece by piece, so you can feel way more comfortable about what to do with your money. Let's dive right in. But first, let me ask you something. Think about the money in your savings account right now. You're doing the right thing by putting it away, for sure, but what if I told you that by just sitting there, your hard-earned cash is probably losing its real-world buying power every single day? I know, it sounds crazy, but it's a financial reality we all need to face. And that right there leads us to the fundamental problem with just saving money in the traditional sense. In our economy today, just setting money aside in a bank account often isn't going to be enough to build any real long-term wealth. Here's why. It's like a slow-motion tug-of-war. On one side, you have your savings account, which might be earning you around 4% interest if you're lucky. But on the other side, you've got this sneaky thing called inflation. That's the rate prices for gas, groceries, everything goes up. And that's often chugging along at 4, maybe 5% a year. So when inflation is higher than your interest rate, your money is losing the race. It can buy you less this year than it could last year. So you might be thinking, okay, what else is there? Well, fixed deposits, they lock your money away so you can't touch it. Gold, the prices are all over the place, super volatile. Real estate, come on, you need a massive amount of cash just to get in the game. And trying to pick individual stocks yourself, wow, that's practically a full-time job, and it is seriously high risk. It's easy to see why most people just feel stuck. So the real question is, how can you get your money to actually work for you, to outpace inflation and grow without needing to become some kind of stock market genius overnight? There's got to be a better way, right? And this, my friends, is exactly where mutual funds come into the picture. They were basically invented to solve this exact problem, to give everyday people a way to get into the world of investing. I love this analogy because it's just so perfect. When you invest in a mutual fund, you're not the one behind the wheel trying to navigate the crazy traffic of the stock market. Nope. You're hiring a professional driver. You just tell them your destination, maybe it's retirement or a down payment on a house, and they use their expertise to handle all the tricky driving to get you there. So what is it really? At its heart, a mutual fund is just a giant collective pool of money. You, me, thousands of other people, we all chip in. That creates one giant fund, and then a professional manager takes that money and buys a whole bunch of different investments, stocks, bonds, you name it. It's the power of teamwork for your money. Okay, so that's the what. Now let's get into the how. How does your money actually flow through this system? Let's break down the mechanics, and I promise it's a lot more straightforward than you think. Let's just follow the money. First, you invest your cash. That money gets collected and pulled together by a company called an asset management company, or AMC. Then a professional fund manager takes that giant pool and invests it across dozens, maybe even hundreds of different places. Now here's the key part. You don't own tiny bits of all those individual stocks. Instead, you own units, which are basically your share of the entire fund. Think of it like owning a slice of the whole pizza. And the price of one of those units, that's called its net asset value, or NAV. Honestly, don't let the jargon scare you. Just think of it as the price tag for one unit of the fund. It gets calculated every day after the market closes, so you always know what your slice of the pie is worth. Now, not all mutual funds are created equal. They come in all different shapes and sizes, each designed for different financial goals and different levels of comfort with risk. Let's walk through the 3 main types you're going to see out there. So at a high level, you have 3 main buckets. You've got equity funds, which mostly buy stocks and are really aiming for higher growth. Then there are debt funds, which are more conservative and invest in things like government and corporate bonds. And then you have hybrid funds, which, as you can guess, invest in a mix of both, trying to balance that risk and return. And if we zoom in just on the equity funds, you can really see this classic trade-off between risk and potential reward. Large cap funds invest in those huge, stable, big-name companies, so they're generally lower risk. On the other end of the spectrum, you have small cap funds, which invest in smaller, up-and-coming companies. They have higher potential for growth, but they also come with higher risk. And mid-caps, you got it. They land right there in the middle. So here's a quick little summary. Equity funds are for people looking for growth who are okay with higher risk. Debt funds are for those who might be more focused on protecting their money. And hybrid funds give you that balanced middle-of-the-road option. The whole key is just matching the type of fund to what you're trying to achieve with your money. But listen, no investment is perfect, and it is so important to look at the whole picture, the good and the not so good. So let's talk about the really powerful advantages of mutual funds and also the risks and costs you absolutely need to know about. Okay, so the big wins. Number one is diversification. You know the saying, don't put all your eggs in one basket? This is the definition of that. You're instantly spread across many investments. Number two, you have a pro managing your money for you. And three, they're super affordable. You can often get started with a very small amount. Now, for the other side of the coin, there's always market risk. There are no guarantees, and the value of your investment can go down. And there are costs to know about, like the expense ratio, which is a small annual fee that pays the manager, and sometimes an exit load, which is a fee if you sell your units too early. They aren't hidden, but they are important to understand.
Whew, okay, we've covered a lot today, from that hidden problem of inflation all the way to how mutual funds can be a potential solution. But remember, the single most powerful tool you have is knowledge. Investing isn't about taking a wild guess, it's about understanding your options. So the real question isn't just about what to invest in, it's what's your next step to learn more and empower yourself on this financial journey. Because that first step is always the most important one.